Hello, everyone, and welcome back to Wise Credit Management. This is the last lesson of our class, Lesson 10, Credit for Mortgage Approval. Mortgage middle score is very important, and you need to know the right one. You've got several loan options. We're going to go over all of them in depth, including VA, conventional, USDA, and FHA. We're going to talk about your debt to income ratio, which is basically the percentage of your debt payments compared to your income. And we're going to talk about the impact of debt other than your mortgage payment and the impact that your other debt, including a car payment, is going to have on your ability to qualify for a mortgage. And we're going to talk about, everyone should remember our favorite couple, Curtis and Angela. We've taken them all this way from, we'll say, a lower credit score, paying off their loans, to where they can qualify for a home loan. We're going to go back over some of those most relevant details, and we're going to talk about some of the things that you can do if you're in this situation and you actually need to increase your credit score very quickly over a short period of time. And then what if you've got a little bit longer? So we're gonna discuss some of the details that you can use to get you qualified for a mortgage. And with that having been said, let's get started. And hey, if this is your first time joining us, we're so happy to have you here. This is just a short introduction and a review of the Essentials class. We have several pretty simple goals for the class. Mainly, I want you to understand the principles of wise credit management. My name is Jason Johnson, and while I was an active real estate professional, I focused on first-time homebuyers, many of whom needed help with their credit. Then one day, I believe that God put it on my heart to develop the program that I wish existed for people with credit problems. I know this class isn't the most entertaining, but I believe that it will be the most informative for you. It's completely free to students. It's the most comprehensive program that I know of, and if you pay attention and learn the material, you will be able to build and maintain a good credit score to help you accomplish your goals. I want you to learn how credit really works while being simple and avoiding too much complicated math. It's wisdom that works in the real world. All views expressed are my own and from my experience as a former mortgage professional. Just like your accounting professor won't do your taxes for you, I can teach you how the credit system works, but I can't help you with your credit. On the other hand, what if you do need a professional to help you out? Well, we do have members that can help you. Most real estate professionals can't, or rather shouldn't, try to help you out with your credit because it's just not what they do. You don't really need to understand something as complicated as credit algorithms. You just need to know someone who can understand it. If you need help with getting a good credit score or buying a home, we have a directory of professionals who are ready, willing, and able to help. The directory also has many other types of professionals who you might need along the way. I'm not endorsing any specific company or service, but if that person lists their company on this website, you know they're willing to help you on your journey. And if you don't want to call professionals one by one to explain your situation and see if they can help, you can go to wisecreditprofessionals.com and write one time about the details of your situation, then sit back and let up to 3 of our Wise Credit professionals contact you about how they can help. I show you a lot of screenshots of other companies' websites so that you can see where the information that I get comes from, but the class is considered a new work for education and commentary purposes and therefore does not violate copyright law. Many of the screenshots that I use are directly from the company that calculates your FICO credit score and from the big 3 credit bureaus. We do offer affiliate links, and I would appreciate if you use them, but I also strongly encourage you to use the affiliate links of the other members. When you open accounts with one of these companies, you'll get your own affiliate links offering either cash payments or statement credit, which could add up to over $1,000. And you can see how easy it is to forward the link to this class as well as your own affiliate links to anyone who might need this class. And if you want to see what new opportunities are available since I created this video, you can go to the home page and click on Options and Opportunities for you. This is where you can find our directory to local professionals and not just someone on the phone offering you a rate they can't actually give you. And you can also find affiliate links to other companies that can help you along your journey. Guys, who wishes I would talk just a little bit faster and make the videos just a little bit shorter? Well, I can. Just go to your settings and adjust the playback speed. Guys, thank you so much, and with all that having been said, let's begin. Proverbs 24:27. Complete your outdoor work and prepare your field. After that, you may build your house. Now, how is that relevant to this particular lesson? First, prepare yourself financially to own a home before you buy. In other words, have a stable job, low debt, good credit, good savings. So that's really solid advice for everyone who wants to own a home. Now, quick review of some of the lessons that we've been over. In lesson 1, we talked about the system, the path to wealth, and developing good goals. One of those goals is to get you on the right side of the wealth gap. That is where you create a situation where you own things that appreciate. In other words, houses appreciate, cars depreciate, and credit cards create financial slaves. Well, on the haves side of the wealth gap, you own. Usually you own a house, you don't rent. Usually you've got low debt instead of high debt. On the have side, you've got profitable skills. In other words, you've got a good ability to earn income as opposed to a slightly lower paying job. You also spend money very prudently versus unwise spending, and you actively invest, whether that's in your own home, in a 401k, whatever you need to do to set money aside for your future self. Wealth is basically the ownership of appreciating assets. People who own appreciating assets are on the right side of the wealth gap, and the wealth gap separates the haves from the have-nots. Now, like I said, we've been talking about the wealth gap. I want everyone to imagine, and obviously this is a stock photo, no one try this literally, but just imagine what it is to try to take the leap from here to here, and you've got this big gap underneath. Imagine the world disappearing between your feet in order to get from this side. When you're renting and you've never owned a home before, you're about to take on $300,000 or more, maybe a little less, maybe a little more, but hundreds of thousands of dollars in debt in order to own a house. It's an amazing thing to do, especially the first time. I'm really proud of and I'm really happy for anyone who's going through this process. But I also know what it feels like, especially the first time. I remember it. The first time that you do this, you feel like you're nervous, you're anxious, you've got all of these conflicting emotions that you know this is the right thing to do, but you're also very nervous about it. Well, frankly, in order to bridge that gap, and it's not intended to be a joke, but feel free to laugh a little bit if you want. In order to create a bridge to where you don't have to do it by yourself, it looks so much easier to jump over that gap if you've got this big bridge. And really what I designed this class to do is to give you the knowledge that you need to bridge the gap and begin building wealth. I also built this class in order to attract professionals who are willing to teach it, who are willing to go over with you step by step what you need to do in order to get over that gap. So wise credit professionals, people who are volunteers, people who volunteer to teach you and who are here for you, who know what you're going through, who have common terms, and a lot of them have taken that jump before. They know exactly what you're going through. So professionals help bridge the gap, and that's really what this class is designed to do, to help you to where it's not just taking that huge, tremendous leap, especially not by yourself. We help bridge the gap. In lesson 2, we talked about the 3 main credit bureaus that they collect information on your debt payment history. We talked about the fact that potential creditors request a copy of your payment history, which is called a credit report, and they can request it from any one of or all 3 of these particular credit bureaus. And we also discussed how you can get a copy of each credit report and monitor each credit report. In lesson 3, we did a very deep discussion about how credit scores work and how different accounts affect your credit scores. Remember Curtis and Angela? This is our hypothetical couple that wants to own a home, but they've got a high debt burden. They have credit scores in the mid 600s, but they feel hopeful that taking this class is going to give them the knowledge to own a home. So, one of the biggest questions that they can ask is, what credit score do they need in order to qualify for a home? Well, obviously, there's no right answer. Ideally, you'd have a 760 mortgage middle score or better. And sometimes, really, you could make the argument now that there's a 780 category, but whether or not that's going to give you a much better rate, we're not really sure. But it really depends on the program and your down payment and various other factors. And actually, we're going to discuss that here in a little while. But one thing that I wanted to mention, the minimum credit score is about 500. Now, if you've got lower than that, you might need to approach a credit repair professional and talk to them about what you can do to get your credit score up. And hopefully 580 is really the minimum that you'll be qualifying, or that you'll have when you seek to qualify for a mortgage. But remember that there are many different loans available with different qualifications. So I created a quote myself, and maybe this is what they'll put on my tombstone. Uh, it's hard to think about, but credit scores are an objective way to calculate lending risk based on credit history. I think that kind of sums up everything, but it is a little complicated of an explanation. Well, let's ask, who creates your score? Who exactly scores your credit report? Well, the Fair Isaac Company, also called FICO, FICO, the acronym. They started in 1989. What they do is they sell your FICO score. They create a scoring algorithm. And when they look at your credit report, they issue a score based on all of the information that's on your credit report. That, like I said, that creates a score that 90% of all lending decisions are based on. In other words, it's the industry standard, and it's what I teach this class to. Now, it's not the be all end all of mortgage scoring. Your credit union might have a different scoring technique that they use, but this is the one that I focus on in this class. And you can get that through myfico.com. And we'll talk about that a little bit later. So we've introduced most of this material to you before. If I'm going over it again, it's just to reiterate some of the most important parts. There are different levels to scores: 800 to 850, exceptional, very good, good, fair, and poor, and you can see all that there. But Experian wants to mention that 67% of Americans have a good or better FICO score. That's something to remember, that 67% of Americans have 670 to 850. So that's something to keep in mind. But Experian goes on to say that specifically a credit score is designed to predict your likelihood of falling at least 90 days behind on a bill within the next 2 years. In other words, they are trying to predict your future behavior by looking at your past behavior. Now, why do companies put so much of an emphasis on credit scoring? Well, and we talked about 760 or higher getting really getting the best rates. So if you've got a 760 through an 850 credit score, you've got these two combined is 2.5%. You've got a 2.5% chance of getting 60 days behind or more on a mortgage within the first 2 years. That's really what this graph is saying. Okay. Now, in contrast, if you have an under 600 credit score, you've got a 27% chance of falling behind on your mortgage within the first 24 months. So that's a predictor, a statistically relevant predictor of how well you will do in paying back your mortgage, which is why they use credit scores. Now, we emphasize it a lot. Credit scores at 760 and above, and maybe 780, but we emphasize 760 and above. Those credit scores are going to get you the lowest interest rates, the best terms. So I compare, and this, remember, these numbers are based on that particular time. Interest rates change daily, and the chances that these numbers are going to be the same for you at the point that you're watching this are virtually zero. But a 760 credit score for a $300,000 loan at 20% down and certain other factors, that's going to get you a $1,900 a month mortgage payment versus a 620, which will get you a $2,300 mortgage payment. Now, I'm just glossing over all these smaller numbers, but basically you're going to wind up paying over $300 more per month if you have a very low credit score compared to a 760. That's my main point, that you're going to wind up paying $300 more per month on your home loan. Or conversely, if you follow my steps, you could actually save $300 more per month or qualify for a significantly nicer home. We've talked about this several times. Basically, what I want you to get out of this particular example is, so this $30 right here is going to give you your 3 mortgage FICO scores. Now, we're going to talk about that here in a second, but you can see this $30 as basically a pre-application fee. And I think that I should have put pre-application fee here, but it's just to let you know exactly where you stand. And looking up your credit scores yourself does not count as a hard inquiry, so it does not hurt your credit score. And just so you know, I have this Premier account over here. I always want to know what's going on with my FICO, so I've got their Premier monthly membership that monitors my credit for me. So I do this myself, and I'm recommending that you guys at least pull one time. You can buy it and cancel it, but know your FICO middle scores. What happens if you pull up your FICO scores and for your Equifax at 747, TransUnion 751, and Experian 748? What's your middle score? Well, this is your lowest, this is your highest, and this is your middle score, and it's all in a tight range right here. But 748 is going to be your middle score. Well, is that lower than 760? Yes. We talked about 1977 being a 760 payment. Well, if you've got a slightly lower credit score, that puts you in a slightly higher interest rate. That makes your hypothetical payment $45 more per month. So you can see that there is a difference in between the different credit scores, and getting close basically costs you $15 a month more per $100,000. I know it's not the exact math, but guys, based on where interest rates are at the time that you're watching this and when you apply and when you close, the interest rates do matter. But if you're looking at a 748 mortgage score, that's pretty good. And paying $45 a month more, be a homeowner. If you're looking at this scenario, go ahead and apply, get approved, and begin your path down the wise path to wealth, so to speak. Go ahead and get started. This is just where you are. This is where you qualify at. Go ahead and get started. I thought a lot about whether or not to even include this slide because it does get complicated. If you're not a math person, I try to teach this class to people who are not math people. But if you're not a math person, don't worry about this particular slide at all. You do not need to understand it. But for those of us who are as analytical as I am, maybe you're an engineer or something, you want to get technical, you want to get into the details. This is the loan level pricing adjustments for Fannie Mae. It's just an example, but it gives you a good idea of exactly what we look at when we go to, and I'll say we, I'm a former mortgage professional, so what mortgage professionals have to look at and take into account when we're determining your credit score versus your interest rate. Fannie Mae puts out these charts that tell us exactly what additional pricing you're going to have to include. Now, the least complicated way to explain this, these are upfront fees over here. This is a percent of the loan balance that you take out for a down payment that's less than 5%. So most of you, well, I'm teaching this class to first-time home buyers or people with lower amount in savings. So if you're getting one of these lower down payment loans, this is the category you're looking at. With and I talk about it over here, with less than 5% down, 780, they're going to charge your lender basically a fee of 0.375 to make this loan. So it gets slightly better than 760 pricing, but this is 0.375 of the loan amount. If your credit score is below 660, they're going to charge an additional 2.125. In other words, over here is 660 and below. So you're basically looking at 2.5% more as a fee in order to originate your loan and get the best interest rate at the time. So that's the impact that your credit score has. You wind up having to pay 2.5% more, or what we do is increase your interest rate to compensate for this 2.5% more. That's where it gets far more complicated and far more into the specific numbers that I would have to dedicate an entire class to doing that. But I wanted you guys to see that we're not just making stuff up. This is what Fannie Mae actually charges in order to originate these loans. I also wanted to mention two things down here. If we're talking about a manufactured home, right here, that is 0.5% more across the board on top of all of these. So wherever you are up here and you want to buy a manufactured home, add 0.5 to that. And we're going to talk about this here in a few minutes, but your debt to income ratio, if that's over 40%, you're going to wind up with an additional charge. So I wanted to mention all these things, and there's all kinds of different add-ons here. But the reason that I'm mentioning that, it does get complicated, but there are reasons that your interest rate gets higher based on as your credit score goes down, your interest rate goes up. So how do we get you qualified based on credit? This class is specifically focused on your credit, and we're going to talk about the minimum necessary to get you approved for each program. Not the wonderful best case scenario, but the minimum required. We're trying to keep it as simple as possible, especially for you guys who don't like doing math. Some of my best friends don't do math at all, and they don't understand me when I start talking about things like that. So I try to teach to people who don't quite understand math. I keep it as simple as possible, few specifics and numbers and all of that. Guys, my main point, and you're going to see me repeat it over and over, this is about principles. Talk to a mortgage professional for the details. Well, what kind of mortgage professional should you talk to? I always suggest that if you're participating in a group, talk to a mortgage professional who takes time out of their day, their Saturday, their Sunday, or Wednesday night, or whenever you meet. Talk to somebody who volunteers to come and help you understand what you're doing with your credit. Talk to a local real estate agent, get on the website and look up local professionals, or go to wisecreditprofessionals.com and input your specific situation and see what several different mortgage professionals get back with you and want to talk to you about. So guys, please use the people who are familiar with this program to help you through whatever problems you're facing. It's actually really important, and I'll discuss that here in a little while. But basically, different companies have different requirements for the same exact loan. And one point that I want to bring up, this video is hosted on Google or on YouTube, and I'm not quite sure whether or not I can use the word for it, so we'll say the illness. Back when things started shutting down, and the illness first broke out, some mortgage companies, I remember one in particular, actually did a requirement for FHA loans that you have to have a 700 or better credit score in order to qualify for for an FHA mortgage with them. And I kind of thought to myself, why in the world would you even offer FHA loans if you require them to have a 700 credit score or better? Not everybody requires that. And if you went to that particular bank and they declined you, you might not know that somebody else is willing to approve you with a 640 credit score. So talk to different professionals. Feel free to speak to different people. It's not so much that you're going around until you find the answer that you want, but different professionals might have a different answer based on what their company is willing to offer. And we talk about overlays. The 700 credit score requirement is an overlay over and above what the minimum for that program would have been, which would have been for automated underwriting 640. So they made it even more difficult to qualify with them. And one thing that I also want to mention, banks are not always the best option. Sometimes going to a independent mortgage professional is a better option. And I've got this picture of presumably a mortgage professional at her desk, and she could be working for a bank, she could be working for a independent mortgage origination company like I had going on, but talk to several different mortgage professionals and see what they have to say about your situation. Okay, now we're getting into a little bit more of the process. What is that mortgage professional going to do? They're going to take your information and enter it into a computer program. Most lenders rely on what's called automated underwriting for approvals for a mortgage decision. So what happens is your mortgage professional enters your information into this computer program, and the program itself looks at all the information that they're putting into it. And it does get kind of complicated, but your income, how much money you have in reserves after you close on the loan, how much money you're going to put down, all of those factors. Plus, it takes into account your credit report. It automatically reads your credit report and determines whether it's willing to approve you for the mortgage program or refer the program for further review. So hopefully after this class you'll be able to get a approval from an automated underwriting system. Now that gives you a pre-approval. So that means that based on the information that you submit to the mortgage professional, the program is willing to accept you and it's willing to pre-approve you for that mortgage, but it still has to go through underwriting. Now, the automated underwriting is the program. Underwriting itself is the actual person who verifies the information. But the bottom line is, and there you can see it down at the bottom, get pre-approved for your mortgage. Okay, now what happens when you actually submit all of your paperwork? You've got a home, everything's moving along. An underwriter is going to take a look at it. So an underwriter takes a look at the pre-approval and says, hey, I need, based on this pre-approval, I need to see, it could be your W-2s, it could be your bank statements, it could be verification of funds to see where your down payment's coming from. There are all kinds of things that an underwriter is going to look. We've got our underwriter over here saying, hey, I'm glad you got pre-approved. Now we need to back all of that information that you submitted to the computer up and say, okay, where is it actually in a hard copy that I can see it, and verify that you've done everything right. So we're verifying all the documents for final approval. That's what an underwriter does. Next, we're going to talk about hard inquiries and specifically rate shopping. So the FICO scoring system takes into account the idea that you might want to apply for certain loans with several different companies. In other words, you want to go and apply for a mortgage or auto loans with different companies in order to find the best interest rate that you can get. So that category is specifically called rate shopping, and it gets rate shopping treatment. Now, FICO scores do not count these inquiries against your score during a 30-day period. 31 days after the first inquiry is when your credit score decreases. So a shopping period applies in which all inquiries within that shopping period count as one inquiry, and it doesn't affect your credit score for, like we said, until the 31st day after the first application is submitted. For mortgage FICO scores, the window is 14 days. So in other words, during a 14-day period of time, you can go and apply to, let's just say, for example, 3 different mortgage companies. So within that 14-day period of time, you can apply at 3 different mortgage companies, put in 3 different applications. They each pull your credit score, and it only will count as one inquiry, but not until the 31st day after the first inquiry is made. So that's a kind of a complicated way around to explaining that FICO takes into account the idea that you might apply at several different places for a mortgage. It's not, I'm not saying it's encouraged, but it's definitely factored into the scoring model. So my summary is that you can apply for a mortgage with multiple companies. In other words, you'll have different hard inquiries within a 14-day period of time, but it will only count as one inquiry, and it won't increase your credit score until the 31st day after your first inquiry. I hope that that's a really simple way of explaining everything. Next, we're going to look at several different types of mortgages and some of the details within those mortgages. We're going to talk about conventional, VA, FHA, USDA, and we're going to talk about the fact that not every lender offers every different type of loan. And it's possible to qualify for at least some of these loans, actually all of them, without a credit score at all. But I want to remind everyone that that will get much higher interest rates than if you have a good credit score. When applying for a conventional loan, terms are going to vary widely, mostly based on your credit score. Higher credit score gives you lower interest rates and lower private mortgage insurance, if applicable. We're going to talk about that here in a second. It's a complicated subject. We're going to talk about that. And for most conventional loans, you can get a loan with as low as 3% down. With the Veterans Administration loan, and thank you, veterans. Check your eligibility. You guys are going to know how to do that with your DD 214 and your time of service and everything. But check your own eligibility to make sure that that you would qualify for the VA loan. Most VA loans, you're going to be able to qualify with 0 down. Now, if you have a lot of rough spots on your credit, talk to a lender. But most of the time, you can get 0 down payment. But you want a 620 or better to get, like we talked about, to get pre-approval through automated underwriting. For VA loans, to make it through, non-medical collection accounts will affect the maximum loan amount. Talk to a mortgage professional about your specific situation. With FHA, oh goodness, it gets really complicated with what they're willing to approve and not approve. But with a minimum 500 credit score, you should be able to get approved with 10% down. But there are a lot of different things that you need to take into account. If you've got a 500 credit score, you almost certainly have collections and probably no good accounts, probably no positive accounts. If you just go through lesson 4 and start rebuilding your credit, you could probably rebuild up to 580 in a very short period of time. Well, with a 580 credit score, you can get approved for a mortgage with as low as 3.5% down. But many lenders require at least a 640 to get through automated underwriting. With USDA, that's for rural area homes. They have a minimum of a 500 credit score requirement. It's better to have 640 for automated underwriting, and it has a zero down payment option. Now, let's take a second and talk about your mortgage payment. Now, that's split up into the acronym PITI. So if someone says, what's your maximum PITI? That means principal, interest, taxes, and insurance. Principal is basically the amount of the payment that goes toward paying down the balance on your loan. Usually that's a very small amount when you start, so don't be surprised by that. Interest is the amount charged on the balance. When you start, this is the majority of your payment goes to interest. Taxes are the amount of whatever the local government charges you for schools and government services. And insurance, obviously homeowners insurance, and whether you have PMI or MIP. We're going to talk about that. In fact, we're going to talk about that right now. But that's what a PITI means. It's just your mortgage payment. And for conventional mortgages, PMI can range from between 0.25% and 1.5%. Now, you get assessed that fee annually, but you pay it monthly in your escrow account. And it's based on your credit score and your down payment. So it really kind of depends on what your situation is as to how much exactly you pay in private mortgage insurance. Next is FHA mortgage insurance premium. Obviously, this is for FHA loans, and instead of calling it private mortgage insurance, they call it mortgage insurance premium. Don't ask me, I don't make the rules, it's just the way it is. This is about 0.55 as an annual fee, but paid monthly, and regardless of credit score. Now, this can adjust based on the amount of down payment that you have, and it can adjust based on the amount of loan that you get. So talk to your mortgage professional before you quote me on this, but this is for a typical 3.5% down under the qualifying amount, and that'll give you a good idea of what your annual fee is. And with 10% down, your mortgage insurance premium is removed after 11 years. But with 3.5% down or 5% down, anything less than 10%, the mortgage insurance premium is charged until the loan is paid off or refinanced. So don't worry about 20%, that doesn't count. It's when you get the loan paid off or when it gets refinanced. But obviously, it'll reduce slightly every year over time as you pay off the loan. Next, USDA, their annual fee is 0.35%, annual but paid monthly. And one way that I'm going to illustrate that, 0.35% times $100,000 is $350. Divided by 12 equals about $30 a month. So you're looking at about $30 a month per $100,000 to get a USDA loan. Again, thank you, veterans. VA has no annual fee, no private mortgage insurance. All of that is taken care of through the program. You don't have to worry about it. So what are the funding fees? Now, we had talked about conventional loan funding fees earlier. Well, these carry certain fees of their own. FHA, it's 1.75. VA, it's 2.15. And USDA, it's 1%. And these funding fees can be wrapped into the loan. So you do not need to show up with 1.75% more. In other words, 3.5% is what you need to show up with. You can get a VA loan with zero down, and the fee would be wrapped into the loan, so you don't have to come up with 2.5% just to get the mortgage. That's kind of my point. And like I said, conventional varies. Like we talked about, these funding fees over here depend largely on your credit score. So total fees, conventional, $0. And like we said, really that varies. So conventional $0 varies. PMI varies as well. VA, you've got a funding fee of 2.5% plus nothing. So you don't have mortgage insurance premium, you don't have private mortgage insurance, none of that. So 2.1 1.15 is your fee. FHA is 1.75, so just a little bit less than the VA's fee, but your mortgage insurance premium, like we said, is about 0.55. USDA is 1% annual plus and they're calling it basically annual fee of 0.35. So that gives you a really good idea of what your fees are going to be, but just keep in mind that you really don't need to know what your fees are. Talk to your mortgage professional. Interest rates. Basically, what you do is you take an interest rate and you multiply it by the outstanding balance equals the interest charged. And I give a really, really, really simple example. None of these are exact figures, but 6% interest divided by 12 gives you 0.5% per month times 100 grand just per $100,000 of loan amount equals $500 a month of interest. So that's what your interest rate does to your payment. Now I want to take this is like I keep saying, a little bit more complicated, but it's also pretty important. What I want you guys to understand, what I want all of my students to understand out of this, how to compare loans when you're looking at different interest rates and different fees. So the interest rate, everybody can understand what an interest rate is, and that's something that's very easy to quote. Then you've got the fees. Well, how do you calculate an interest rate and turn it, or I'm sorry, fees, and turn it into the equivalent of an interest rate that you can add to the actual interest rate to create something that you can compare apples to apples with? So APR includes your PMI or your MIP, your closing costs, etc., into your interest rate to give you an annual percentage rate, which is your total cost, including fees and your interest rate. So if someone is quoting an interest rate to you, they could quote a very low interest rate with very high fees. Well, if you think that interest rate is the most wonderful thing in the world, you might get very surprised when you wind up having to pay a lot more in fees, which could be good or it could be bad depending on how long you hold on to that particular loan. So, APR is your way of comparing apples to apples. When you ask, if you apply with 3 different professionals, ask them interest rate and fees, but also know that APR is what you're really wanting to compare between 3 different mortgage lenders. Property taxes, it's basically the amount of money that the government charges you to make everything work, from roads to schools, government services, etc. You pay that yearly, but it's calculated monthly. In other words, it's divide that yearly by 12 and add that to your monthly mortgage payment. Like we talked about, that's part of PITI. Insurance, again, part of PITI. It's the last I. So property insurance is required as a condition of any mortgage. You know what property insurance does for you. And the yearly premium is divided into monthly payments. Now, where do those monthly payments go? An escrow account. They take your monthly payments for your insurance and your taxes, let that accumulate in an escrow account, and then pay it whenever those payments, whenever the yearly payment is due. Now we're going to get slightly more complicated. You can see the calculator coming out, but I'm going to try to explain it in the most simple way, and I'm driving toward a main principle when I go over all these numbers with you. So, what's your debt? Now, there are 2 different types of debt that are 2 different categories of debt that we're gonna talk about. But basically, debt is your required minimum monthly payment on all the debt which is listed in your credit report. Income is your verifiable. In other words, look at your W-2s or your pay stubs, 2 years worth of tax returns. That's what your income is going to be. Well, what's your debt to income ratio? It basically uses the minimum monthly payments on your credit cards, and usually with term loans, they have a specific monthly payment. So you add all of those up to get your monthly debt. You must report your debt that shows up on your credit report, or prove that someone else pays. Now, going back to lesson 9, if you co-sign for someone, let's just say you co-sign a car, you can that could show up on your credit report, and you can prove that someone else pays for it using 12 months worth of payments, that they provide you with proof that you can hand to an underwriter, and an underwriter is going to say, yes, that person's been paying for this car for 12 months, so we're not going to include that in their total debt payment. But it's a lot easier if you didn't co-sign for that person in the first place, but I understand if you did. Okay, one more thing that I like to mention for a car payment. What you can do is not include in your monthly debt a car payment that has 10 months or less, or fewer, actually, 10 months or fewer payments left on the term. But FHA has a little add-on to this. If you're going for an FHA loan, the monthly payment has to be less than 5% of your income to not be included in your monthly debt to income ratio. So I wanted to mention that. Guys, if it gets too complicated, ask a mortgage professional. And also remember, auto leases are included regardless of the remaining time on your lease. There's no, I'll say, little way to get around that. You must report some types of recurring payment that don't show up on your credit report, including alimony and child support. Now, I get this straight from HUD requirements, so I'm not making these things up. This is what's required. So alimony and child support is required to be reported as a monthly liability. Your income sources, like we talked about, pay stubs, W-2s, or a 2-year history of self-employment on your 1040. Now, I will include one more thing that's not a part of HUD. When you're applying for certain loan programs, they allow bank statement income. In other words, if you can show, I think the very least is 3 to 6 months, the most recent bank statements for 3 to 6 months. But that's like a 25% down that you have to come up with. But if you show your bank statements, just showing income from whatever business it is that you're in, even if it doesn't show up on your 1040, or you have tremendous expenses to show on your 1040, so you wind up not paying a lot of taxes. If you're self-employed and you have a lot of money to put down, you can use bank statement loans in some programs, but those are rare. Talk to a mortgage professional. Now we're going to talk about joint income. Basically, what HUD wants you to do is use the lowest middle score of the two borrowers. And in community property states, they use the credit report and liabilities of a non-borrowing spouse to calculate debt to income. So in community property states, they don't let you get away with not including your spouse, because they're going to look up and say, hey, you're married, it's community property state. And also they're going to want to know why you didn't include your non-borrowing spouse in with your mortgage application. So just remember that when it comes to married but trying to get around something if you just apply by yourself. Now we're going to get into the details of your debt to income ratio. It's actually pretty simple if you look at it this way. It's just your monthly debt divided by your monthly income. That equals your debt to income. It basically gives you a percentage of the income, of your monthly income, that you spend on debt. It's a really simple concept that I want you guys to understand from the start. It's not quite as complicated as it sounds, but we're going to make it a little more complicated here in a minute. Remember Curtis and Angela? We did this in lesson 6. They've got a truck payment, minimum payments on their loans. All that adds up to $640 per month. So that's their minimum monthly payments on all of their outstanding debt. So what you do is, okay, so we're going to start here with the front end ratio. This should also be called the housing debt to income ratio. We've got $1,500 here. That's their rent. So the housing ratio does not include their car payment, their minimum monthly payments, all of that. It just has their principal, interest, taxes, and insurance. And I'm using a $1,500 a month rental payment. Now we're going to divide that by their monthly income. I just said $3,000 a month. However much that is for you, you're going to have to figure that out. But for both of them, if they both make $3,000 a month, that gives their household income $6,000. Okay, so you divide the rent divided by their monthly income equals 25%. And over here, you can see on the, maybe, hopefully you can see it on the calculator, but $1,500 divided by 6,000 equals 0.25. So they've got a 0.25 housing front end ratio. Now we're going to add in their other monthly debt. Remember the 640 from earlier? So we're going to add in the 640 to the $1,500 a month in rent divided by $6,000 equals 35%. So 35% of their monthly income goes toward what would be considered debt. Now I know rent isn't necessarily debt, but it's what we're using as their housing payment. Okay, so and this is just an example. However much your rent is, you can calculate this by yourself. But next, what I want to mention is, and this is kind of a principle that we use in the mortgage business, about 30% of your monthly income is the maximum mortgage payment you can use to qualify for principal, interest, taxes, and insurance. And really, it's higher than that. We're going to see that in a moment, but about 30%. Okay, about 40%, and it's just a little bit higher than that, especially if you have a higher credit score. But about 40% of your monthly income should go toward all of your debts to qualify for a home loan. So basically, you've got 30% of your income should go to housing, and an additional 10% should go to whatever additional debt you've got. With FHA, those minimum requirements, like we said before, I said 30%. With FHA, it's 31%. USDA, 31%. Okay. Their back end ratio requirement is about 43%. So in other words, all of your debts added up shouldn't be more than 43% of your income. With VA, this is so much more complicated than I could do an entire class on just VA loans, but about 41%. But don't be afraid if this is a little bit higher. VA, they calculate their debt to income a lot differently than what I'm doing here, but it's about 41%. USDA, like we said, 31, 46 with automated approval. So you can get a 46% of your total income to your monthly housing payment plus whatever other debt that you have. Or if you have questionable credit and you need a manual underwriter to take a look at it, if it can't go through automated underwriting, you need a 41% back end ratio. So conventional, it's going to be about 43% with a 3% down payment. Guys, that's really complicated, but hopefully those of you who are still following along, I'm trying to explain it in a very simple way. So we're going to use, as an example, for Curtis and Angela, the FHA and USDA both use about 31%. So you're going to multiply 31% times this $6,000 a month income to come up with a maximum mortgage payment of $1,860. Well, what does $1,860 buy you? Well, according to this, at the interest rates at the time, that would get you a home price of about $220,000. Now, that includes a little bit for taxes and fees. Guys, this is so simple, and I don't want to use any kind of actual figures. This is just an example to teach the principles, but you have to apply it for your own circumstances. Now, the back end DTI would be 41% times their monthly income, which equals the maximum monthly debt that they can have. So 41% times 6,000 equals $2,460. That's about the maximum debt that they can have. And like we talked about, this could be 46, but basically they're looking at needing to have debts lower than $2,460 per month. So Remember, their monthly debts are $640. So you're going to take that 640 and add it to what we put as their rent, which is $1,500, which creates their back end ratio of about 35%. Well, what happens if they both have car payments? And I put the same exact car payment on their loan amount. It's just everything here is simple, 445 for both cars. I know that's unrealistic, but two car payments, that extra car payment gets us up to $1,086 per month in other debt. Well, what happens now? That $1,086 plus the $1,500 in rent gets us up to 43% as a back end DTI. That's about the maximum that you really want to go. Well, like we talked about, the back end DTI times the monthly income equals the maximum monthly debt that you want to have. Here's the thing, this is the way that we calculate what your mortgage payment can be given your situation. So we take the back end ratio. How much money can you spend in total on debt? 41% times your monthly income. It's that $2,460. We've already calculated that. That's the maximum that you can have in debt payments per month. Well, you've already got $1,086 in debt payments. That only leaves you left over with $1,373 as the maximum mortgage payment that you can have to qualify for a loan with. So in other words, you can only qualify because you bought a second car, you can only qualify for $1,300 per month in mortgage payment, 1373. We don't use exact numbers, but remember that they were able to qualify for, before they bought that second car, $220,000 house. Now with that $1,300 a month, they can only qualify for a $162,000 house. In other words, and this is a long way around to making my principal point, that second car payment cost them the ability to qualify for a $220,000 house. Now they're down to 162. So it costs them the borrowing power of $58,000 to qualify for a home loan. That second car may very well have put them out of the ability to qualify for the home that they want to buy. Now, that's the way that we calculate the monthly housing payment that you can afford if you have too much in monthly debts that are already outstanding. I know that's a little bit complicated, but if you're following along, that's the way that we calculate everything. And really, I did all that to emphasize the point. You don't want car payments. You don't want high debt payments when you're going to qualify for a loan. Drive a cash car, bite the bullet, and ride a moped if you have to qualify for a home loan. As always, contact a mortgage professional before you begin. We've talked about your insurance payments. Guys, everybody knows what home insurance is. So if something happens, if something terrible happens, your house is going to be protected. But the thing is, there are three different things that you need to think about when you're talking about how much insurance to get. Your monthly premium, that's going to factor into your debt to income ratio. Service is really important, but your coverage, your deductible, I want you guys to ask yourself, if something terrible happens, if a tornado hits and there's damage to your house, can you afford the deductible that this insurance policy requires you to come out of pocket with? That's a very important question. If there's a tornado or something, by the way, when you see people on TV saying what the tornado sounded like, be happy for them that they survived the tornado. Tornadoes are not fun, and they are loud. Next, I really want to talk to you guys about something. This is very important. Let's just say that you're driving home from work one day, you're in a car wreck. Guys, specifically the breadwinners, think about it this way. If there's a car wreck and you don't make it home, what happens to your family? So you just bought a house. You've got, what do we say, $1,800 a month payments to make on that house. Now your wife's got to do that alone. That leaves them homeless, desperate, needy. That gets into a situation where you basically left them without a home. So I want to strongly encourage all of my students to approach a life insurance agent probably before you even start looking for a home. In fact, right now, you should probably contact the life insurance agent. But if you don't have life insurance, please get life insurance for your family at the very least. It creates a situation where you can leave them an inheritance of life insurance to pay off the mortgage that you guys qualified for. So please consider that. Men, women, whoever's the breadwinner, guys, please insure that house in case something happens to you, to your income, your ability to make money. So that's where life and health insurance can really help you out. So please consider that. Remember, King David, when he knew that his time was coming, he had to leave his kingdom, leave the people who trusted him to be their king. He had to leave them with someone in charge. He left that to King Solomon, or then his son Solomon, who became king. But he also left him with a group of wise counselors. In other words, people around him who could give young King Solomon good advice. And he also left King Solomon with all of the building materials to build the temple. Based on that principle, the principle of King David leaving King Solomon in a good position to carry on and to carry forward, we should always consider what our death will mean to our family. So I want you guys to strongly consider life insurance as part of that. Next is down payment sources. Basically, that's going to be either money that you've had in the same account for at least the past 60 days, the sale of a previous home or other asset, or retirement account, or a gift. Reserves are verifiable money that you have left over after close. We measure that in terms of monthly housing payments. In other words, how many monthly housing payments do you have in reserve? And it's an important factor in the automated underwriting system for most of the loans. More reserves equal better chances of being approved. So you remember that our couple, Curtis and Angela, had we were calculating that they could afford an $1,860 per month mortgage, but their monthly rent was $1,500 a month. Well, one thing that I would strongly advise you guys to do if you're looking to buy a house and qualify with $1,800 a month in mortgage payment, whatever the difference between the mortgage payment that you're going to qualify for and your monthly rent right now, please put that into a savings account. In other words, $1,800 per month in mortgage payment versus $1,500 per month in rent. Please put that into a savings account. That's $300 per month. Now, if you do that for a year, 300 times 12, $3,600. That winds up being, and for those of you who know where I'm going with this, you can already see it. That winds up being about 2 months worth of reserves that you have in a savings account automatically because you wound up saving this money, the difference in your rent and your future mortgage payment. So that's something that I strongly emphasize that everyone needs to do is have at least 2 months worth of reserves in a savings account so that when you close, you've got that extra amount and it'll help you qualify for a mortgage. It'll also look good if an underwriter takes a look at your loan and sees that you've been saving the difference between what your current rent is and your future mortgage payment. You've been saving that as if you're spending it anyway, then that'll help you out when an underwriter sees it. So there's a lot of good things to do in that. We kind of mentioned it before, but rental history can be on your credit report, but it does not affect your mortgage FICO scores. We use verification of rent called a VOR done through your landlord, or 12 months worth of canceled rent checks, or some type of automated payment system. But a lot of times your rental history can be checked. And some programs now, it gets complicated, but they can go and look at your bank statements in order to determine that you're paying your mortgage, when you're paying it, that you're paying it on time, and how much it is. So we can go back and look at your rent history through your bank statements. Now, these are options for 3% down, home ready or home possible. Whichever one, talk to your mortgage professional. I keep saying that. You don't have to know all these details, but they're really meant to assist first-time home buyers or lower income buyers. Minimum of 620 to 660. They want you to have a 700 or better credit score, or FHA would probably be less expensive because of the PMI. And we already talked about APR. Guys, by now you can see what I was talking about when I was saying that this class builds on itself, that we already discussed APR. Like we already talked about, VA has a zero down program. It usually has slightly better interest rates, and you can get approved without a credit score, or hopefully you've got a 620 or better. USDA is for rural. Guys, I have such a problem saying this. Rural property. Rural. I'm sorry. I grew up on a ranch. It's rural property. And there is a limit on the household income that you can make. Minimum credit score 500 with a 41% DTI. We already kind of talked about that. It's 46 with automated approval. So, also, reserves are very important in getting automated approval. If you're not having to come up with any kind of down payment, you should be able to have some money in the bank when you close. And FHA, popular with first-time home buyers. Guys, I can't express this enough. It requires strict inspection and appraisal. In other words, there are requirements on FHA loans that a lot of houses don't meet, which is why our friend Debt Stinks, it was probably easier for him to qualify for a brand new build than it would have been for a existing property using an FHA loan. And it's the most forgiving on your credit history. You can have a foreclosure just over 3 years prior. So in other words, you lost the house already 3 years ago and you can qualify for an FHA loan again. Talk to your mortgage professional, but it's possible. 2 years after Chapter 7, and only 1 year of on-time payments in a Chapter 13 bankruptcy. So, guys, FHA, if you've been through some things, FHA can work for you. It does not take medical collections into consideration. Probably going to hurt your credit score, but you don't have to worry about medical collections. Non-medical collections don't need to be paid if the combined total is less than $2,000. That feeds into a very important question. Should I save money for down payment, or should I pay off collections? Keep this in mind. Talk to your mortgage professional, please. They can do all this math for you and help you figure out which collection should be paid. They can walk you through that process. But FHA is very forgiving in terms of being able to approve you and approve your credit. Their down payment, like we talked about before, between 500 and 579, you can only have a maximum loan to value of 90%. In other words, 10% down. If you've got over 580 credit score, the maximum loan to value is 96.5%, which is 3.5% down. And you can get that down payment from any number of sources, including a nonprofit. So we've went over several different things that you can qualify for. VA, then we've got your conventional 3% down programs over here. Then we've got USDA, and USDA is here, and we've talked about FHA. So you guys do have options for very low down payment, 3%, 3.5% being pretty much the maximum that you're going to have to come up with. And we already covered this slide, but I'm using this one to lead into the next one. Banks aren't always the best options, but Sometimes credit unions might have it's called a portfolio loan, but basically they might offer you a loan with zero down and or zero private mortgage insurance. It gets complicated and we're not going to cover all of that here, but your credit union might actually offer you a zero down loan with zero PMI. So it's something to at least ask about, inquire about. Also, one thing that I wanted to mention, some banks do offer, they might offer the best rehab loans. So in other words, when you buy a house and you also need money to rehabilitate it, and then whether or not you need to get another loan that's a permanent loan, all of that can be worked out through your bank and some mortgage companies. Guys, check around and don't be afraid to ask multiple companies what they have. Don't get caught in a situation like I was when I first my first rehab. It was a complicated situation, but I was lucky enough to have somebody who took me to the right bank. Like we talked about over and over, I'm kind of beating a dead horse here, but I want you guys to understand how important this is. Just to simplify things, higher credit scores, for the most part, will get you lower interest rates, lower PMI, lower housing cost, lower housing payment, and you can afford a better home for the same payment. And we've got my favorite slide again. As your utilization rate goes down, your credit scores go up. So if you want to try to maximize your credit score, have a 1% utilization on your revolving accounts, have term loans that are at the very end of their term. In other words, your car payment, we talked about the 10-month rule, having a low balance left, like 10%, that helps your utilization on term loans. And please don't apply for new credit within 1 year of applying for a home loan. Like we talked about, a new car will drive down your credit scores. It'll drive up your debt to income, which means that it drives down the house that you can afford, and it can even take you into a place where you cannot qualify for a home. So always remember that when you're planning ahead, please stay away from cars. And basically, with this class, we're trying to get you to a place where you get approved. Low debt, the end of term on any outstanding loans, have money in your savings account. Guys, the best advice that I can give, and it was given to me before, eat beans and rice. Before you're applying, simplify your life. Do not spend money that you don't need to. Don't spend it on credit cards. Don't buy anything new. Keep as much money in your savings account as possible. We see in Luke the principle that he who is faithful in what is least is also faithful in much. It doesn't take a whole lot to start building credit. We saw that in lesson 4, that you can use authorized accounts, starter loans, secured credit cards. Authorized user accounts don't count toward certain parts of your credit score, but they can help. And we studied 850 credit scores and how to maximize your credit score before you apply. 5 term loans, 11 revolving accounts, a good mixture of accounts, a low utilization ratio. We keep talking about 1%, as low as possible on each account. Have old accounts. Don't apply for new credit if you don't need to, and no derogatory marks at all for 850 credit. But if you do have derogatory marks, like we keep talking about, you can apply for certain loans. With Curtis and Angela, we keep talking about them as our cliche couple. So what if Curtis and Angela already have, let's just say, a wonderful opportunity came up, and we're going to walk them through this in the Wise Path to Wealth, the advanced lesson that you're going to have access to after you go through the graduation class, the next class. But let's just say that a wonderful opportunity came up and they need to qualify as soon as possible. One of the things that obviously they need to talk to their lender first. But one of the things that they can do is pay down a revolving debt, which will lower their utilization. Or if they have a first party collection account, they can pay that down or pay it off and use something called Rapid Rescore. We'll let your mortgage professional talk to you about that. But those are a couple of the things that they can do to bring their credit score up within 30 days of needing to apply for a mortgage. If they've got up to 2 months, we'll say that, 30 to 60 days, talk to your lender, obviously. Pay down revolving debt, and that should, by the next credit card statement, that should be reflected, so you don't need to use Rapid Rescore. Ask for a credit line increase for any revolving debt that you have unless it will cause a hard inquiry. And you can also add a authorized user account. So maybe one of these two has an old account that's on their credit, but not on, if they're newlyweds, they might not have it on each other's credit. So they can add each other as authorized users to help each other out. That's possible. So there are some things that you can do between 30 and 60 days. Well, if you've got up to 6 months, if there's anything bad on your credit, do lesson 7 and then do the advanced disputing class after you graduate, and take anything that you can, any bad marks on your credit, off. Do a debt consolidation loan. Hopefully, in a 6-month period of time, if you open a new account, open a new loan, pay off your credit cards, and start making payments toward that debt consolidation loan, you should have a higher credit score at the end of that than you do when you first start. Also, you can get a new credit card. Now, if you've got credit scores like these, maybe it's not going to work for you. But if you've got a higher credit score, but you've still got a balance on a credit card, and you've got 6 months to work through this, what you could do is open up a new credit card and transfer a balance to the new credit card with a 0% interest rate and start paying that one down. That will decrease your utilization. So there are a number of things that you can do inside of 6 months. And if you've got more than 6 months, you can come up with a pretty good plan. New credit card, new term loan, all kinds of things. Now, one thing that I wanted to mention, so like we were talking about, if you need to increase your credit score within 180 days, we'll say that time period. One thing that you could do, and again, I don't like using the word hack, but I know that it's a modern day phrase. One thing that you can do, I'm not necessarily suggesting this, but it is possible that you can open up something like a self-lender loan and get a term loan for 12 months. Pay that 12-month, pay the balance down. Okay, so you make 2 months worth of payments. That gets you down to having 10 months left, and it develops a payment history for you. Okay, but then you pay the balance down, not off, but pay it down significantly to maybe 20% of your outstanding balance. That way you'll only have a couple months left, and it will help out your utilization ratio. So you could do all of this, and maybe it'll increase your credit score by a little bit. If you're desperate for a few points and you've got 6 months to play with, this is something that could work for you. Now, we talked about Curtis and Angela in lesson 6 extensively. They used $100 a month to pay down their debt. Their score increases as the utilization ratio decreases. So, guys, pay down outstanding debts. We took them through that 31-month period of time where they paid down $17,000, starting with $100 a month in extra payments, and it took them from the 600s or so to about a 750 mortgage score. They did great. Well, let's ask what they're qualified for with a middle score of 748. Well, VA, conventional, USDA, FHA, like we'd said before, they're going to have certain funding fees and certain PMI or mortgage insurance premium or annual fee, depending on how everything breaks down. But they're going to choose the one that is best for them. But with a high credit score and a low debt to income, they're going to be able to qualify for anything that they choose. And let's just say that one of them is a veteran, so they're able to qualify for every loan out there. Congratulations, guys. Newlywed couple starting off. And like I keep saying, in the Wise Path to Wealth, we're going to take this young couple through their lifespan. And I'll give you a hint. If you never sell a property, in other words, your starter home, if you use that and convert that into rental property, over the years you can build a rental portfolio that outmatches pretty much any normal stock market returns that you can use for retirement. So that's all covered in the Wise Path to Wealth, which is the advanced class after you graduate. Back to Rebecca. She is our young college student. She's starting with no credit. She might have one bad account. We talked to her about how to dispute bad credit in lesson 7, and we talked to her about how to build credit in 2 years in lesson 4. So maybe her degree program is 2 years long. She would be able, and obviously, if she's that young, she didn't go through the military, so she's not qualified for VA, but conventional USDA FHA, she's qualified for all of that. When she graduates and gets a job and gets probably 2 to 6 months worth of income, plus she's going to need a little bit for the down payment and reserves. Like we said, lesson 7 talks about how to handle bad credit. Paid collections still affect your mortgage FICO, so that's something to always remember. So we've got Robert here who, like we talked about before, at 18 he got a job, he got himself a sports car. By 20 years old, he destroyed his sports car and used credit cards, and now he's got a repossession and collections. Let's just say that he used Self-Lender and Credit Strong to rebuild his credit. Well, if he works his way up, he might be able to qualify for USDA or FHA, assuming he didn't go through the military. So with both of them together, they're probably limited to USDA or FHA loans. And remember, lesson 8 is all about credit counseling and bankruptcy protection. My favorite verse, joy cometh in the morning. Guys, remember Charlie? He's the guy that I gave all kinds of problems to. Divorce, job injury, he's behind on his bills, 500 credit score. Basically, in lesson 8, we had him file for bankruptcy. He recovered. He got caught up on child support. He opened up, let's just say, new accounts with Self-Lender and Credit Strong. So he's rebuilt his credit. Remember, this gentleman debt stinks. His testimonial was that within 3 years, he was able to buy a new construction loan using FHA. Now remember, he had 6 student loans outstanding that were not discharged, so he actually had credit coming out of bankruptcy. But he also rebuilt his credit and he was able to close with an FHA loan. So what does Charlie have? What options does he have? Well, if he was in the military, he could do the VA. Probably not a conventional until he's done a few years of credit rebuilding, but USDA and FHA are options available to him. And on this last slide with Charlie, I've got him looking for houses. Like I said, joy cometh in the morning, and he's looking for houses with either his real estate agent or we'll all be happy for him. Maybe he started a new relationship in the past 2 years. And one more thing that I want to mention, guys, this is so important. Be careful with the real estate agent that you approach. Most real estate agents are nice and they'll smile at you, but some of them don't want to work with first-time home buyers. In this class, we're very blunt about things that you need to know up front. Some real estate agents just don't want to work with people, especially going through the FHA, because the property requirements are so strict. So if you can find a real estate agent that's willing to work with you, that's the person that you should probably stick to. So you look for somebody who's going to look for homes for you, who understands the local market, who understands your needs. And I strongly suggest using someone who either is referred to you through the program or you find through Wise Credit Management. I've done my best to make it easy for you guys to find a buyer's agent, but I strongly recommend that you find yourself a buyer's agent who's willing to do all this work for you. In lesson 9, we talk about how to handle identity theft. Like I said, I learned from my experience, and now I'm trying to teach you guys how specifically to handle any type of identity theft. So review lesson 9 if that's a problem for you. And guys, like I keep talking about, I did my best to provide you with the information in this entire class, in this lesson, with everything that I do to provide you with the knowledge, with the people that you're going to need, the professionals that you're going to need to be able to qualify for a home. So I've done my best to give you the knowledge, the wisdom, and the understanding that you need. And you know I really take this verse to heart. Sometimes God provides people to help you when you really need it. Our professional members participate in wise credit management to serve you by doing what they do best. And remember, you can watch these videos online, but you should also find a local meeting to come and share your difficulties and also your successes. Remember, we celebrate success. I tried to make it easy to find local groups and local professionals on wisecreditmanagement.com. You know, back when I was younger and just starting out, in fact, it was before I became a real estate professional, I found a house that was a really good deal, so I put it under contract. It was being sold by a couple that was getting a divorce and it needed a lot of rehab work. It was a really great deal, and I had a pretty big down payment. So I went down to my bank and they actually said no. And the guy who turned me down was actually kind of rude about it. Luckily, I didn't give up and I found a different bank who would do the loan for me. But while I was building this class, I decided I wanted to make it a lot easier for you to find somebody who can help you. All you need to do is type in some details about your situation, and you can have up to 3 professionals contact you about how they can help you. So, whatever your situation is, maybe you've got a rehab that you want to do, maybe you want to get an FHA loan, but you've got bad credit. Whatever it is, you can enter some details about your situation, and we'll help you find a wise credit professional to help get you approved. Well, what if you want to find a great deal like I found, but you're not sure how to go about doing that? Well, what you need is a buyer's agent. What you should do is enter in what you're looking for, and we'll help you find a local real estate agent that can help you find the deal that you need. Just type it in, and we'll help you find a professional that'll work for you. And of course, you need insurance, but really what you want is the best coverage on your home for yourself and your family. And guys, don't be like our friend Charlie and have a major health problem without life and health insurance. Especially if you're buying a home and you have a family, please contact an agent to get yourself proper coverage. And guys, if you have to make major decisions about your retirement account, especially if you're going to withdraw money for the down payment, please talk to a certified financial planner. Also, if you're a freelancer or some type of gig worker, please contact someone about getting a Roth or a self-employed retirement program started. And guys, if you're behind on any of your bills, maybe late fees are being added onto your account, maybe you're considering bankruptcy, please contact a certified credit counselor about a debt management plan to see if you qualify for Chapter 7 or if you need to prevent foreclosure or automobile repossession. It's time to talk to a bankruptcy attorney. On the other hand, consumer protection attorneys specialize in the Fair Credit Reporting Act and suing for violations, so they can actually wind up getting you money out of these companies that are harassing you. And credit repair organizations can help you by professionally disputing bad debt. Many of them are former or even current mortgage professionals who know the laws on disputing and how to get things removed from your credit report. And finally, if you need a reliable and inexpensive car like our class mascot, the Golden Nugget, then you should contact one of our dealers who can help you find what you need. So we've made it to the end. What's your homework assignment for this lesson? Guys, ask yourself what is stopping you from making the leap to ownership. And then, when it's time to answer that question, please go find a wise credit professional to help you get across that gap and help you own a home and start your way to where you want to be. So see us as a bridge, see this class as a way of helping you get where you need to go. As always, create your own success story. You've made it through the class. You're about to graduate. We're going to talk to you about that in a minute, but you've made it this far. Always keep track of everything that you've got going on and help create your own success story. And remember, we do celebrate success. Join our social media groups, like and subscribe, and your success can actually inspire someone else. If you know someone who needs this class, it's awfully easy to send them a text message and just say, hey, I know that you're struggling with this. We talked about this. Whatever language you want to use with your friends, with your family, I tried to make it very easy to spread this particular course to the people who you know need it. We focus on goals and not obstacles. Don't worry about what's in your way. We've given you a lot of knowledge and a lot of wisdom to overcome anything that is in your way, and we try to help you get started. The graduation class is all that you have left. We're going to summarize the important parts. We're going to talk about a final exam. Guys, you know me by now. It's not difficult. And we're going to talk about what happens after graduation, because really the end for you is the beginning of a wonderful journey. In graduation, we're going to summarize the class, give you a final exam, and I'm going to sort of make a speech. Really, I just want to thank some of the people that participate in this class, some of the people that helped me get where I am, and we're going to help you make the next step in your journey. That's what graduation's about. Guys, I can't wait to see you. Like I keep saying, this class is on the website, so you have to be logged in to get to it, complete it, and then get to the advanced classes. So with that having been said, I'll see you at graduation. Thank you so much, and may God bless you on your journey.